Hello and welcome. You're watching us here on Chartbusters on CNBC-TV18. I'm Manglam Malu. With me this morning is Sonal Bhutra. The markets have been, all over the place since morning. They opened higher. Thereafter, we saw a bit of a sell-off from the lower levels. We've seen a bit of a bounce once again, but the mid-cap index is the one which is struggling the most. And the chart that tells you the story of the day so far, which is 1 hour of trade, is the advanced decline chart. We started with nearly 3 stocks advancing for 1 declining. And now, as we speak, the advanced decline lines have not only intersected, the decline line has moved much higher, and they are at the widest point of today's trading session, with 1,700 stocks declining for every 1,000 stocks which are advancing right now. So it's all over the place. It has been volatile, but so far the market has respected the 17,000 mark as an important support. Hi, Sonal.
Hey, Manglam. Good morning. It's been a busy morning, right? Not just as far as the markets are concerned, but what's happening in the industry, the mutual fund industry, so to say. Of course, we'll discuss that in greater detail. But for now, we'll take a look at what's happening in the markets and get a technical check as well. Manas Jaiswal is joining us now. Manas, good morning. Thank you so much for joining us. As Manglam said, it's all over the place for markets. What are you suggesting would the next levels to watch out for on the Nifty be?
Good morning, Sonal. Good morning, Manglam. First of all, I think the trend is definitely negative because Nifty is not sustaining on high levels. It is facing a lot of resistance in the range of 17,150 to 17,200. And look at the pattern today. I feel that Nifty can again go down and test 16,850 mark. So even at current levels, I think one can take a chance, take a short call here. Stop loss should be around 17,120. These are cash levels, and downside, the target would be around 16,850. But I think the weakness, you can see more weakness in Bank Nifty because Bank Nifty could not sustain our 200-day moving average. And looking at the pattern today, I think it can again go and test 39,000. So here also you may see some more weakness.
In that case, what do you do with the stocks? I mean, do you take short positions or do you take some long positions?
Manglam, 2 sectors are definitely looking weak today. So first is NBFC space because most of the finance companies are looking weak on the charts. My pick would be L&T Finance Holding, where one can create short position. Stock has broken its 200-day moving average. It is making lower tops and lower bottoms. So take a short call here. Stop loss should be around 85 rupees. Target would be around 79 rupees in L&T Finance Holding. And second sector, which is looking very weak on the charts today, that is steel, or you can say metal counters. So I would like to go with Jindal Steel. That is a sell call. The stock has broken the key support of 545. It has fallen below 100-day moving average. So one can create short position in Jindal Steel also. Stop loss should be around 551. And here the target would be 520.
Okay, all right. Thank you so much for joining us, Manas. So that's all about the technicals of the markets. With that, we'll shift focus to our special segment where we'll get you a few ideas for profit from Money Control Pro. Bharat Gianani of moneycontrol.com joins us now to talk about a stock that he's tracking closely. Bharat?
Today's ideas would be KNR Constructions Limited. The highway construction and awarding activity in the current fiscal so far has kept pace with the record levels witnessed last year. The central government in its union budget hiked the capital expenditure on highway construction by 24%. We expect NHAI to award 14,000 kilometers worth of road projects in next 1 year or so, which will be higher than the levels witnessed last fiscal. KNR Constructions, which derives 80% of the order book from the road segment, will be primary beneficiary of the increased road projects. The company recently bagged 3 road projects worth rupees 2,000 crore. The company has an order book of 2.3 times its FY23 projected revenues, which provides a healthy growth visibility over the next 2 to 3 years. The company is diversifying into the railway and the metro segment, which would be positive. The company concluded the sale of 3 projects in the month of October and is looking to monetize the HAM projects which are ongoing at an appropriate time. KNR is amongst the quality stocks in the construction space and is amongst our preferred bets. At the current market price, the stock is trading at a PE of 15 times its FY24 projected earnings. Investors can add the stock in the portfolio.
All right, thanks a lot for that, Bharat. With that, we'll step into a short break. On the other side, we'll get a corporate conversation going. Sanjay Sethi, who's the Managing Director and CEO of Chalet Hotels, joins in to talk about the company's new acquisition and expansion plans. Stay tuned.
Welcome back. You're still tuned into Chartbusters on CNBC-TV18. Let's get stock specific now. Chalet Hotels will acquire the Duke's Resort in Khandala for a sum of 133 crore rupees and reposition it as an upscale green lifestyle resort. To learn more about the company's plans with this particular property, the acquisition, and get an outlook for the business as well, we are now joined by Sanjay Sethi, who is the Managing Director and CEO of the company. Mr. Sethi, good morning. Thank you so much for joining us. Well, those who live in Mumbai, of course, know very well about this Duke's Resort. You've gone ahead and acquired it. Tell us, what is the net outflow for the company? How will you be funding it? Do you have enough cash on your books, or you will be taking some debt?
Good morning, and firstly, I come to you from the Duke's Retreat today. Great resort, iconic in nature, great weather, and we already have some waterfalls due to the recent rains visible. In terms of acquisition, yes, we're very excited about this Duke's Retreat acquisition. It begins our journey into the leisure and resort spaces for Chalet Hotels. It's been acquired with currently 80 rooms. We have an expansion plan which will increase the capacity by 50% or more. And of course, there's upgradation that's required. Overall, we've acquired this for 133 crores as the enterprise value, and there was cash on books, so the overall cost to us is 156 crores. It's being funded by internal accruals from the business this year. That's where we stand today.
So there was 23 crores of cash on the books. Yeah, so there was 23 crores of cash on the books, right? Okay, so your net outflow is
change, yes.
Right. So your net outflow is close to around 133 odd crores, all of that funded internally. You said that you plan to take this up to a 120 room property from 80 rooms that there is. It requires some expansion, upgradation and renovation. How much more money are you going to spend on that? I ask this mainly because I'm just trying to get your overall investment in this and the timeline by when this will be ready for everyone to visit in its new avatar.
Sure. So we continue to operate it till we start work on the site. So timeline of construction will only be from October onwards. It'll probably be about a 12-month renovation and expansion plan. So we should be ready by September of the year after that. But we'll do it in phases. It's not going to be shut down. So it'll be operational throughout the renovation and expansion period. Also, the expansion is on a different site, so it doesn't affect the existing hotel. The total capex outlay is still being worked out, but it is going to be roughly around 10 lakhs a room on the renovation side and roughly around maybe, say, 50 lakhs a room on the new room side, which is the additional 40 to 50 rooms that we had.
Okay, right. All right. So that is the additional capex that you will be doing on these rooms. Can you tell us what is the current revenue, average room rental and occupancy of the property? And after acquiring it, what do you plan to take it up to?
Sure. So currently, I think it's going to close roughly around 33 odd crores revenue with an EBITDA of a little under 14 crores, I think, around in that range. We see this position at the upper upscale to luxury segment. The average room rates of the hotel this year are about 8,600. Occupancy is around 70%. We see this being repositioned at the 12 to 15,000 rupee average room rate positioning post the renovation and expansion. We'll be able to get yields significantly or comfortably north of 20% IRRs on a project basis.
All right, I get that. So, just doing some rough math, you said 10 lakh rupees per existing room is the renovation that would come up to about 8 crores, given it's an 80 room property, plus another 50 lakhs for adding another 40 more rooms.
25 lakh crores.
25 crores is that. So that's roughly 33 odd crores.
There is some public areas.
Yeah, some public areas. So say 35 odd crores, 35 to 36 odd crores is what you would be spending on the overall renovation.
It will be closer to 50 crores because we want to enhance the project also.
All right, closer to 50 crores. Right. So your net investment would be close to around 180 crores, on which you expect an IRR yield of 20% is what you said,
North
right?
of 20%. North of 20%. Comfortably north of 20%. Yeah.
Yeah, you've also acquired, the land, Sonmil Industries, along with the building which currently exists. So just wanted to know if there is any other land around the property which has been acquired with this deal as well, which Sonmil holds,
no.
Or is it, okay, that's not the one. And
so it is Duke's Retreat. So Sonmil owned the land. Duke's Retreat was owned the asset, the hard asset of the building. we acquired the two companies which have now 100% subsidiaries of Chalet Hotels Limited.
So there's no freehold land which is around the property right now, which you've acquired along with Sonmil, right?
We get some extra FSI along with this, so we'll have the potential expansion of going beyond the 130 rooms that we have sometime in future. We'll have about 55,000 odd square feet more that we can develop sometime in future.
Okay. Mr. Sethi, this is about the acquisitions that you've made. Do you have any more acquisitions planned, something that you have on your radar? We can hear about it in FY24?
So we've got a lot happening on the project side, right? As you know, that we've about to complete in the next quarter the 168 room in Hyderabad, which is a Westin. We've added 88 more rooms at our Novotel in Pune. We've got a new hotel coming up in Delhi with 400 rooms. In addition to that, we've got potentially a new hotel of 180 rooms coming up in Airoli in Mumbai. And then we've got the two office projects which are near completion, and one in Bangalore, one in Hawaii, in Mumbai. So yes, we've got a lot of capex work that has been happening over the last 3 or 4 years is now coming into a stage where they'll start getting monetized now.
All right. Just a couple of quick questions before we let you go, Mr. Sethi. Out of curiosity, will you run this as a new brand, or will it be one of your existing brand partners? You have Marriott, Novotel, Renaissance, a bunch of them.
Well, still work in progress. More and more going forward, we see us definitely operating the hotels.
Okay.
In some cases, we might take brand partners as a franchise arrangement. But we see ourselves running this hotel either with our own brand or as a franchise. It's something that we'll decide over the next few months. You know, we have about a year or more to relaunch the project post-renovation. So we have the liberty and the luxury of time.
So last question before we let you go, Mr. Sethi, about the current business. What is the expectation for FY24? How has Q4 been? Also because calendar year or FY24 is very happening with IPL, the World Cup. What kind of occupancies are you expecting?
I can't disclose numbers, but I think you picked the right word when you said happening quarter.
Okay, all right. It'll be happening for, of course, the hotel industry and everyone who is a cricket fan as well. Thank you so much, Mr. Sethi, for joining us and detailing to us the plans with this acquisition and the outlook going forward as well. That's the word coming in from Chalet Hotels. So with that, we'll move on and take a short break. But of course, the big story, mutual fund investments where not more than 35% is invested in equity shares of Indian companies will now be deemed to be short-term capital gains. So we'll get you more on that after this short break. So stay tuned for that.
Back, the market cuts have deepened now, especially at the mid-cap end of things, and we have the AMC stocks which are, sulking the most right now. 5% down on HDFC, AMC, among all the others which are lower. But this is on account of the amendment that has come in the finance bill. Mutual fund investments where not more than 35% is invested in equity shares of Indian companies will now deemed to be short-term capital gains. Sonal is at the big wall. She's moved there to tell us more about that. Sonal.
Well, yes, this is a big development, and if passed by the government, should be a big blow to the debt mutual fund category. First, to the basic news, that is, the finance bill says that mutual fund investments where not more than 35% is invested in equity shares of an Indian company will now be considered as short-term capital gains. That is on redemption. It is applicable on all investments made on or after April 1, 2023. So which are the funds which could be impacted where equity portion is less than 35%? That would be debt funds, gold funds and international funds. Currently, these are taxed at a different rate. The short-term capital gains, they are taxed at the slab rate for any individual or the corporate, but the long-term capital gains, they were actually taxed at 20% and also indexation benefit was available. But with all of this, now these gains will be taxed at the slab rate, and hence the indexation benefit that goes away, and the tax rate will, as I said, will be the marginal or the slab rate. Additionally, grandfathering will not be extended to market-linked debentures as well. Now, of course, industry is not happy with this amendment, and it has come in as a surprise as well, because all the focus was on taxation of life insurance policies amounting to more than 5 lakh rupees. Insurance industry had made representations and asked for a relief in form of indexation for insurance policies, but that did not come by. No relief for insurance segment, but a blow to debt funds. With this, government has created level playing field for all fixed income products, and now all fixed income products will be taxed similarly, which makes the debt mutual fund segment less attractive for investors. What are the other categories?
Right, so not only is it no relief coming in for the insurance sector, but a big blow to debt mutual funds as well. Pavitra is here with us as well. She's going to tell us what the experts are making of this move. Pavitra, I guess they're not happy.
Definitely not happy. And, we have been speaking to experts through the morning, and everybody agrees that this has just come as a body blow to the debt category of mutual funds. This, in fact, like Sonal was pointing out, is applicable beyond the debt category as well. So gold, international investing, all of this gets impacted as well. What experts are saying is that the indexation advantage was one of the key reasons why people actually looked at these categories, looked at debt, gold, international funds. So if you take that away, it definitely, comes as a big setback for this category. Further, not only is this proposing the removal of indexation benefit, but it will also be taxed at a marginal rate, right, which is the slab rate. So that is something important to keep in mind as well. Experts believe that in this context, money may now move from this category to sovereign gold bonds and back to perhaps fixed deposits or NCDs in the debt space. Also, another point to note is that in this category, retail investors are not currently that big, right, in the entire fixed income space. So it is really the institutional clients as well as HNIs who perhaps could be harder hit. But all in all, everyone we've spoken to has just said that this is a huge blow for the debt category of funds.
All right, Pavitra. Thank you, Sonal and Pavitra, for explaining this to us and telling us what the experts make of that as well. With that, we're out of time on this edition of Chartbusters, but not, out of time on the discussion of this topic. Trading hour on the other side of this short break. We'll carry this discussion forward with our panel, including AMFI Chairman A. Balasubramanian, DP Singh, Deputy MD and Chief Business Officer at SBI MF, and we also have Firoz Aziz, the Deputy CEO at Anand Rathi Wealth.